During the GameStop GME trading frenzy in early 2021, many retail traders across Europe and Asia turned to contracts for difference, CFDs, instead of directly buying the underlying shares. CFDs allowed them to take positions in GME without needing full capital or direct ownership. This enabled leveraged exposure, short selling opportunities, and quick entries and exits with lower capital requirements. However, some traders also faced heavy losses due to the amplified effects of leverage. This example illustrates both the appeal and the risk of synthetic instruments in volatile market environments. A CFD is a financial derivative that allows traders to speculate on price movements of an asset without owning the asset itself. The contract pays the difference between the opening and closing prices. CFDs can be used on stocks, indices, commodities, forex, and cryptocurrencies. No ownership means traders don't own the actual stock, commodity, or asset. Leverage allows CFDs to be traded on margin, enabling greater exposure with less capital. The bid-ask spread is where broker profits come from, not commissions in most cases. Dividends and corporate actions are still relevant, as traders may receive dividend adjustments when holding CFDs on dividend-paying stocks. Pros include access to a wide range of markets from one platform, the ability to go long or short easily, low capital requirement, and fast execution. Cons involve higher risk due to leverage, no shareholder rights such as voting, financing costs for overnight positions, and regulatory restrictions in some regions. Synthetic instruments replicate the economic performance of an asset but don't confer legal ownership. Examples include CFDs, total return swaps, and synthetic ETFs. Underlying assets involve direct ownership. For example, buying Apple stock gives you a share of the company and voting rights. Comparison shows synthetic tools are better for short-term speculative trades, while underlying assets are better for long-term investing and wealth building. Counterparty risk arises because you depend on the broker or issuer to honor payouts. Leverage risk means losses are amplified with small price movements. Market gaps and slippage can occur as high volatility leads to wider spreads or execution at worse prices. Lack of transparency is another concern, as the pricing mechanics of synthetic products are not always clear to retail investors. Short-term trading makes these ideal for day traders or swing traders. For hedging, they're useful in protecting downside in a stock portfolio without selling. They're also suited for speculation in hard-to-access markets, allowing exposure to foreign stocks, indices, or commodities not listed on your home exchange. Understanding when and how to use synthetic instruments is key to managing risk and optimizing performance.